Joining us here at Post 9, former Barclays CEO Bob Diamond, now CEO at Atlas Merchant Capital. Bob, it's great to have you in.
Carl?
Does this morning's print do anything to change your view?
No, I have been for a while slower. As you know, from the beginning of the year, we really saw the fourth quarter as the first time that they would cut. Here we are in September, almost to the fourth quarter. My sense is that the biggest single risk for the Fed is to do too much too quickly. So I'm firmly, as Sarah is, in the 25 camp. I think 50 would be a statement that is inconsistent. But most importantly, I think what they should do is only 25. I think it would be, you know, with the markets doing well, with labor doing well, with the economy doing well, that just it creates the risk that we would reignite some inflationary fears. And then, you know, the worst case here is that, you know, in the near term, we have to begin tightening again. So I'm firmly in the camp that what's correct is 25 basis points, and I'm feeling pretty confident that that's where the chairman and the FOMC is as well.
What do you think the roadmap looks like in terms of what a terminal rate will end up being?
You know, it's interesting, two aspects. I was saying to Sarah earlier, we just announced this morning a joint venture with A&D Mortgage, which is residential mortgage space. You know, why is Atlas Merchant Capital in that space? I think there's going to be a turnaround in the mortgage market. We had $4.5 trillion in issuance in 2021, $1.5 trillion in 2023. Obviously, rates were a big part of that, Carl. So I think that market is expecting a decline in rates. You know, my own view is that prior to 2008, when we had kind of 1% rates forever, the average funds rate for decades was 4%. So in my mind's eye, if the Fed continues to ease, to encourage a soft landing, if inflation stays under control, then I think the terminal level for Fed funds is probably around 4 and 4.5%.
It's interesting, all the banks getting out of the mortgage business. You're going into the mortgage business.
Absolutely. It's the time to do it. And, you know, 2/3 of all those residential mortgages really are done by the agencies, about 1/3 by banks in the private sector. So 14 trillion in residential mortgages, and it's a small sector that's the banks and the private market. And much like private credit, I think private companies like A&D Mortgage are going to continue to take a bigger slice of what the banks typically have. So I think that portion of it, the portion that goes to the banks, will increasingly go to the private sector.
You're investing in it, or?
Yes, we're doing a joint venture, right? Yes. So, you know, how can we help them? I mean, they've been doing this for 20 years. They're fantastic at origination. We can help them with the bond buyers, so securitizations, expanding the list of buyers of the securitizations. And then we have a fund called the Imperial Fund, which buys some of the residuals and finding investors for that. So we're very much on kind of bringing more clients and customers in so that we get better rates.
Well, last time securitization moved firmly away from the GSEs into private hands, things didn't go that well, Bob.
There's a sector of that market, in this case, it's called non-qualifying. So a good example is a lot of athletes, a lot of artists. They're very high credit quality, but they don't have a traditional W-2, so they don't qualify for the agencies. So there's a big sector of the residential market that is very high credit, which is very, very high, low loan to value. In other words, the down payments are quite high. It's a really, really interesting sector, and it doesn't qualify for the agencies. And that's the sector that we're really focused on. And it's high quality, high credit,
but a bit
and very low
than what
LTV.
they would, right.
Exactly.
That's going to be one to watch.
It is.
We'll come back to you on that, and we'll see what we get tomorrow. Bob, as always, thank you.
Thanks.
Good to see you.